Good afternoon, everyone. I'm Megan Guy, Director of the Stewart Center for Executive Education at the A.B. Freeman School of Business. Thank you all for joining me today. Before I introduce our speakers, a bit about the Stewart Center. Since our founding in 1994, we have been committed to offering educational opportunities to executives with little or no career interruption. We do this in two primary ways: by housing executive degree programs that allow experienced professionals to obtain a degree while still working, and by partnering with organizations and companies to develop non-degree courses. These courses are designed in close concert with the organizations and tailored to achieve their specific goals. This webinar series, which we're producing alongside the Freeman School of Alumni Relations, was designed to provide unique learning opportunities during these uncertain times, focusing particularly on subjects relevant to the current climate. Discussions with industry leaders and scholars is more important now than ever, which is why I'm so pleased to kick off the Freeman webinar series today with three truly fabulous hosts. Pierre Connor, the Executive Director for the Tulane Energy Institute at the A.B. Freeman School of Business and a Professor of Practice. John Foreman, Lecturer at the Tulane Energy Institute and President of Direct Energy Hub. And Andrew Goldstein, President of Atlas Commodities, LLC. Please keep an eye out for more details about our monthly webinar series, and we'd love to see you at our June installment. For now, though, please enjoy today's discussion. I highly encourage you to participate and ask questions. I'll now pass things over to Pierre. Thank you.
Thanks, Megan. The Tulane Energy Institute is pleased to bring you this discussion about what happened to the price of oil. And I'm sure with a little bit of prodding, we can get our experts to talk about what they think will happen in the future. So at Freeman, we provide comprehensive energy education in business, including specializations in the Master of Management and Energy degree of renewable and sustainable energy, electric power, analytics, entrepreneurship, banking and finance, and about the topic today, we have a specialization in trading and risk management. So we'll be focusing on oil. Now let's put oil in perspective. We should note that the U.S. produces and consumes about 100 quadrillion BTUs of energy every year. That's a lot of energy. Now, of that, wind, solar, and advanced natural gas are the fastest growing sectors, but petroleum is the largest at a little over a third of that energy. Petroleum's primary use is in transportation because of its energy density and its ease of transport. We have almost 3 million miles of pipeline in the United States, and we have more miles of inland navigable waterway than the rest of the world combined. These are very efficient methods to move petroleum products. So before we get into what happened to oil recently, let's talk about how we got here. A coincident flooding of the market coupled with significant demand destruction. First, the U.S. became a net petroleum exporter for the first time in the fourth quarter of 2019. And recently, crude oil production in the United States exceeded that of Russia or Saudi Arabia. Now, that was a result of a number of factors, including the advent of fracking and horizontal drilling technologies combined in non-conventional sources, along with, admittedly, cheap and plentiful capital. Then things change. First, OPEC Plus could not agree on who's giving up market share to the U.S. shale producers, and they increased their production levels. Then came more than a 30% decline in worldwide mobility. And did I say that crude oil is primarily a transportation fuel? Well, the roller coaster begins. So I'm very happy to introduce two experts managing the risks associated with the volatility in this commodity. John Foreman is professor at the Freeman School teaching fundamentals in trading, which is the basis for risk management. John has 20 years of industry experience, including 14 years as a manager of oil and gas marketing for an independent energy producer. And John has been teaching at Freeman for the last 9 years. He's helped launch many a career in energy trading and risk management. He's joined by Andrew Goldstein, the president of Atlas Commodities, a full-service commodity brokerage firm supporting diversification and risk management for both producers and consumers of energy products, crude oil, natural gas, and electric power. Andrew was the head commodity trader and risk manager at MBF Trading before becoming the president of Atlas Commodities. And maybe most importantly, Andrew is the parent of a recent Tulane graduate of 2020. Andrew, congratulations to your daughter. We look forward to seeing her in-person graduation soon and starting her master's degree program with us in the fall. And with that, I'm going to turn it over so that John and Andrew can tell us if someone is going to pay me to store oil in my pool this summer until demand returns. John, you and Andrew.
Good deal. Thank you, Pierre, and welcome, Andrew. We're honored to have you here in our trade room today. As you can see behind us, we have CNBC and software from our trade room sponsors, Refinitiv Icon and Trading Technologies. Before we get started, Andrew, please tell us a little bit about yourself and Atlas Commodities.
Sure. Well, thanks for the introduction, Pierre and John. My background, I was a crude oil trader on the New York Mercantile Exchange for close to 20 years, and I traded this WTI contract that we'll be speaking about today. Currently, I'm the president of Atlas Commodities in Houston, and we're a wholesale brokerage firm. We facilitate trades between producers, hedge funds, banks, speculators in crude oil, natural gas, and Texas ERCOT power.
Okay, good deal. Well, let's go ahead and get started.
Sure.
The June NYMEX oil futures contract expired at around $32.50 on Tuesday. That is quite an improvement from almost negative $38 a month ago on April 19th. It's been a roller coaster for sure.
It sure has.
I'll start with the headline from last month. Producers are paying refiners to take their oil. Once again, producers are paying refiners to take their oil. This negative NYMEX settlement price was for 1 day of the 30-day NYMEX settlement average used to calculate a producer's price. Producers received the calendar month NYMEX average for a given month. For the month of April, the calendar month NYMEX average was about $17 a barrel. Depending upon transportation costs, quality, and the physical price index, most producers sold their oil for more than $12 a barrel for the month, which is not great, but definitely better than the headline. So with that, Andrew, can you please provide a brief synopsis of how crude futures trade and what we mean by contract expiry?
Sure. Well, all commodities, whether it be gold, silver, sugar, coffee, crude oil, they all trade in future months. So currently, the first contract or the spot contract in crude oil that you can trade is the July 2020 contract. But you can trade every month all the way out to February of 2031 right now. Now, each contract has an expiration date. And once that contract expires, if you own a contract, which is the equivalent of 1,000 barrels of oil, you are expected to physically take delivery of that oil.
Okay, thank you. Can you share how this ties to what happened last month with the historic event of crude trading negative for the first time ever?
Sure. Well, as you mentioned, crude has never traded negative. In all my years of trading on the Mercantile Exchange, we never saw that happen. And honestly, I never expected that it would. But we had a perfect storm. You had Saudi Arabia and Russia flooding the market with less expensive crude oil to drive the price down. And on the heels of that, you had COVID-19, where people started sheltering in place. And you had close to 2 months now of less demand with less air travel and less travel on the road.
Okay, makes sense. So who is buying oil futures for less than $0 per barrel, Andrew?
Well, as I mentioned, we deal with speculators. So you have a lot of speculators in the market that are just looking to get in and out of trades and make money on those trades with no expectation of taking delivery of a contract. Anybody that wanted to physically take delivery of a contract, usually refineries, they would have been set up well in advance, at least a week before expiration. They wouldn't be buying that contract on expiration. If they saw a negative price and figured, hey, it would be good for us to get paid to take this crude oil, at that point, they had no place to store it, and they would have had to find additional locations to store their oil, and they just didn't have the time to do that.
Okay, makes sense. So why are U.S. prices moving so drastically, but, for example, Brent crude isn't faring as badly? Can you touch on the difference between the U.S. and overseas market and maybe shed a little bit of light on how they settle differently?
Absolutely, and that's a great question. So the WTI contract is the United States benchmark, and the Brent contract is the worldwide benchmark outside of the United States. WTI is a physically traded product, meaning that when you own that product at the end of expiration, you are taking delivery of the oil. Whereas Brent is a financially settled contract, meaning that wherever it settles upon expiration, you're either making money or losing money based upon where you bought and sold that contract, but there is no delivery expectation or requirement.
Got it. Got it. So let's jump into some fundamentals. You mentioned delivery, and Pierre was debating whether or not to drain his pool this summer and fill it to store oil. Because of the COVID pandemic and the lack of the demand, will the decrease in oil production help balance the supply-demand equation to help support higher prices?
Well, it's funny. I've heard that drain your pool reference, for the past month since the May contract expired. So much so that my phone was ringing off the hook after that happened, because I'm going to take a step back for a second. When I was trading on the Mercantile Exchange, the only people that could trade that WTI contract in the world were the 450 people standing in that pit trading it. We had our customers on the phones, but we were the only people that were allowed to execute those orders. Now with electronic trading, anybody can open an account and anybody can buy or sell crude oil. Now, most people are not expecting to take delivery when they do that. They're speculators and they're looking to just make a couple of dollars. But as soon as the price went negative and people realized that they can get paid to take the crude oil, everybody started looking around to see, where can I store this oil? But by that point, again, it was too late. It was from what I see, barring another pandemic, a once in a lifetime aberration that won't happen again.
Got it. Makes sense. So states are slowly starting to open up their economies. We should see summer driving demand returned. Do you anticipate negative pricing after we get kind of this near-term surge in demand later this year? What about next year? What are your thoughts on seeing negative prices again, or just low prices, Andrew?
I don't expect to see negative prices again, with the states opening up and people getting back on the road. And I imagine that more people will be on the road rather than flying, because it is safer just being, with a few people in a car than multiple people on a plane. I think that as demand increases, the need for that oil is there. And with supply and demand, it's simple economics. As demand increases, the price will rise. And we've seen that. The day after May expiration, when the June contract became the spot contract, it traded down from $20 to, I think, somewhere around $7 during the day, and it settled around $11. And since that time, we traded back up. June went off the board, like you said, at $32.50 on just a couple of days ago. So we had a huge increase in price, and with the states opening up, I think that we'll continue to see a rise in price.
Yeah, I'd like to just kind of clarify something for our viewers. We mentioned oil storage, and I think the general consensus among the public is that Cushing's full, Nederland is full, all the ships are full. The reason oil is negative is because there's nowhere to store the oil. Prior to this, Andrew, you and I were chatting, and that indeed was not necessarily the case. Can you maybe just touch on that a little bit, please?
Correct. A lot of the major hubs may be close to full, but once this happened, that I mentioned that my phone was ringing off the hook, it wasn't only from people that were looking to open trading accounts and buy oil negative, but it was also from people who had storage facilities. They had tank farms that were sitting and empty, West Virginia, Pennsylvania, and they were looking now to take advantage of this influx of people buying and needing to store the oil and offering out their services. But it's a very expensive proposition. To store the oil, it costs a lot of money, and for people to buy it negative and not know when or at what price they're going to get out of it is a very risky proposition.
Understood. So we've touched on a variety of topics. Help me understand how some of these supply-demand fundamentals have an impact on the shape of the futures curve. What is
Sure.
the future curve? Folks on the call have heard words like steep contango or the back of the curve is flat. Help us
Right.
understand these terms relative to what's going on in the futures market. And if you don't mind, touch on the liquidity component as well.
Okay. So in a contango market, typically, a contango market means that the further out you go, the more expensive the oil becomes. So we had when
Hey, just
when,
jumping in, Andrew. So that would
Sure.
mean the August contract is trading higher than the July contract?
Correct. And once in a while, the market goes into backwardation where the front month is higher than the back month, but typically you have a contango market where the back months are higher. So when the May contract expired, a couple of days later, the July contract was trading $17 and the July 2021 contract was trading $30. So you had a $13 spread value between those 2 months. Currently, they're trading 33 and 37. So it's only a $4 spread value because as the liquidity lies more in the front of the board, meaning the closer contracts rather than the back contracts. And at a certain point, as you go further out, the curve does start to level out. So you have a big difference between this year and next year, but maybe between 2021 and 2025, it levels itself out. And the further along you go, the less open interest you have in those contracts, meaning the contracts that are outstanding. So you may have, 350,000 in the front and only 20,000 in the back.
Got it. So with a $4 spread over a calendar year, would you say that physical storage players are incentivized to store oil or not like they were a month ago?
Not like they are a month ago, just based on the price of the spot contract. Because if you needed to buy July for physical delivery, you're paying $34 now as opposed to paying $10 or collecting money in May.
Gotcha. Okay. Well, we discussed the demand side of the equation. On the supply side, OPEC just came out with their deal. They agreed to cut 9.7 million barrels a day in mid-April. Can you elaborate as to how long it takes for those supply cuts to work their way into fundamentals and share your thoughts, maybe
Sure.
just on the whole Saudi, Russia, OPEC relationship?
Yeah, well, the price of crude oil, at the point that OPEC made that deal on April 12th, the price of crude oil had come down from the beginning of the year from $60 to approximately $30. So people thought, okay, they're going to cut production, immediately prices are going to go back up. Two things happened. First, the pandemic happened and we lost all that demand. So it was very hard to get that price back up. And secondly, you can't just turn the spigot and turn the oil off. So although that deal happened, a week before May expiration, it takes, the April 12th deal really wouldn't go into effect till sometime in June. So there's a good, 4 to 8 week lag on while the production is still happening. It's curtailed, but you didn't have a less production of 9.7 million immediately.
What was the term of this agreed curtailment? Do you recall, Andrew?
I don't recall. I do not recall how long it's going to go on for.
Yeah, I think we beforehand discussed maybe we'd see it in place for 6 months or so, and then depending upon how the election goes, things may change one way or another. You maybe want to comment on that for us, please?
Well, listen, when you have different countries involved and different personalities in different countries, anything can happen. At a moment's notice, somebody can say, hey, I'm going to produce more oil. I don't care what OPEC says. I don't care what the United States says. I do feel, though, that the agreement will remain in place at least through the next 6 months, and then seeing what happens with the election, they'll go from there.
Good. So summarizing along this topic, would you say today's low prices are a result of low demand associated with the pandemic or a price war among foreign producers? I know a lot's changed since earlier this year. What are your thoughts about that perfect storm?
Again, and you just said it, I think it was a perfect storm. I think you had the market flooded with oil to bring the price down on purpose. And then you had the pandemic come into effect, and people staying home and not traveling, and that tremendous lack of demand with, as you mentioned earlier also, the United States is the largest producer of crude oil now in the world. But that doesn't mean that we don't have imports as well. So we have all this production, we still have oil coming into the country, you have barges coming over from Saudi Arabia, and now we didn't have the demand for the oil. So you have all of this excess oil being stored and nothing to do with it. The refineries couldn't take it on because they didn't have capacity to refine it or to hold it. And the prices went down because nobody was willing to buy it. And that's why you saw that negative pricing. People that were long those contracts on May expiration and needed to get out. You know, you mentioned earlier the calendar month averages, where the producers average out over a 30-day period and they sell at that price. But not every producer does that. Producers can sell at any given time. You know, the May 2020 contract, they may have hedged their production 5 years prior at $50. They may have sold that oil at $50. And oil trading is a zero-sum game. If they sold it at $50, somebody bought it at $50. Typically, a lot of times banks are on the other side of those trades. So now going into May expiration, those banks are still long those contracts and they need to get out. They're not taking delivery of the oil. So at that point, there were no buyers left and the banks needed to get out. So they were just selling it anywhere that they could.
Understood. Thanks for clarifying that.
Sure.
Recently, I was notified that there was an announcement yesterday that 4 VLCCs chartered by Hess and others arrived in the Gulf to act as floating storage. Each VLCC is good for about 2 million barrels. What does that imply in your mind in terms of future oil prices if you have vessels like that coming into the Gulf to store oil?
Right. Well, again, it's you know, oversupply and a lack of a place to put it. So those vessels are coming to store that oil. Obviously, you know, that oil will be necessary in the future as demand increases. And I do see as demand increases, again, the price will rise. But you also have to look at the cost of the storage of the oil. So, you know, on a vessel like that, it's typically around $4.50 per barrel per month. So if you're talking about 2 million barrels at $4.50, it's $9 million a month just to store that oil on the vessel. You know, and that comes into play when they need to sell the oil. You know, they could take a great loss on that.
So coming from a producer background, I would say that's a pretty bullish indication.
Absolutely. Absolutely. You know, they know that they will need that oil at some point, and knowing that what the storage costs are and being willing to take that risk, I do look at it as bullish as well.
Good, good. We're ready to get this economy going again. Atlas trades different types of energy commodities. You mentioned your background with oil. What are your thoughts on the impact of higher oil prices relative to natural gas in the near term this summer, and then also later in the year? You know, obviously we're going to start burning more natural gas to generate power, and then with the production cuts, especially in West Texas, you're going to see less associated gas. Are you long, short gas? Without disclosing your book, please let me know your thoughts on from that.
So just to clarify, we don't trade. We take no risk here. We just facilitate the deals between traders, producers, trading firms, hedge funds, whoever they may be. So we do have a natural gas options desk. From the business that I've seen coming in, it seems that the traders out there are bullish natural gas in the short term and in the long term going down the curve.
Good. Well, I believe we have a few questions. Pierre, have we received any questions via the message board yet?
Thanks, Sean. Good. I think I'm back on. I appreciate that informative discussion, Andrew and John. Thank you very much. So I think you were getting into the impacts of, you know, natural gas in your view, Andrew. You're saying because someone's asking about the, other impacts, and you're saying it appears that people are bullish on natural gas. Is that your view from what you can see the
Yes.
trading interest?
From the trading interest that we see coming in, it seems that there is definitely a bullish activity, and a lot of these deals are not getting filled because people don't want to necessarily sell into that bullish activity.
Gotcha. And then I have a question here that I think I'll summarize it this way. And we were talking earlier that there's a lot of displacement of different types and grades of crude. So I wondered maybe a couple of things around that people are asking, but do you work with different grades and types of crude oil, and tell us about that?
Sure. So, it's funny. 20 years ago, nobody discussed crude oil. Nobody even discussed WTI crude oil. It just wasn't a topic. But worldwide, there are well over 100 different grades of crude oil. In the United States, there are many, and what happens is the oil needs to get from one place to another. I mentioned that the WTI is shipped to Cushing, Oklahoma, which is the storage point, but there are numerous other storage points for the different grades of crude throughout the country. The pricing of the grades is all based on the pricing of WTI. So you might have a Texas grade that is trading at WTI minus $5 or minus $10. So as the price of the WTI was coming off about 2 to 3 months ago, we saw the price of those grades coming off even further. So we were seeing, and you have to excuse my background noise, I'm on an active trading floor here. Although most of our brokers are working from home due to COVID-19, we have a few in the office. So I'm sorry about that background noise. So we saw these grades trading at an even lower level than WTI as WTI was coming off, which really shows a very bearish signal to the crude oil market.
Along those lines, Andrew, the supply cuts you hear about globally, are those a particular grade of crude? Is that a light sweet barrel, a medium, sour? When Saudi Arabia and Russia say they're cutting production, what exactly type of crude are they cutting?
So I'm not 100% sure of that, but I imagine that if the United States were going to cut, we're talking about our benchmark WTI. So whatever the benchmarks are in those countries, I imagine that that's where the production cut would be made.
Right, and that was a question that I see someone's asking about. You mentioned that, goodness, I said we were a net exporter of petroleum products, but why are we still importing any oil, Andrew, John? Either of you guys jump in. That was a question people didn't maybe understand.
That's a good question. I think it has to do with deals that were structured 5 to 10 years ago while we were still an importer. Now the state of Texas has become a larger exporter than the entire country of Iran or Iraq. So we don't necessarily need those imports anymore, but I think that the deals were structured on terms that we would continue to take in the oil until the end of the deal.
Agreed. And I think it also depends upon the refinery slate and the refined products they're making, right? Some of these refineries were built decades ago, and they rely on a heavier, more sour barrel that the United States does not produce.
Well, that gets into the topic, right into what someone's asking, John. So, we're all familiar with the decline in production from Venezuela, and the fact that our refinery complex in Louisiana was built primarily to handle heavy sour crudes. Is that what you were alluding to, John?
Yes.
Got it.
Yeah.
So let's see. Here's another one, and you did touch on this, Andrew. But the question is, so explain again. What happens to the Brent producers if no one's taking delivery? So you just recap that again, because I think that's pretty significant about why we have negative WTI, but not in the Brent situation.
Sure. Well, the Brent contract obviously is a physical contract as well, but that's not the contract that's traded. The contract that's traded is a financial contract. So there is no delivery if you get stuck along that contract on expiration. The deals, kind of like the deals that we do in physical delivery at Atlas, are between the two counterparties. So there's no trading exchange that is trading those physical deals.
Okay, right. Let's recap that. Okay, wait. Let me John, this some of your prior students here, I can tell, John.
This is when they set me up.
Yeah, they're setting you up. Well, this is Andrew. You mentioned you gave the number on your perspective of storage costs offshore.
Right.
Do you have some perspective on storage cost in other areas? Like we've talked about Cushing, for example.
Right.
Is it similar?
So it's much less. It's much less than it is offshore. You know what?
Okay.
I don't have those numbers in front of me. This is stuff that I was looking into when I received all those phone calls after the May expiration happened, and we started doing a little due diligence to see how much it would cost to store the oil for these people. I don't have those numbers in front of me, but I do know onshore was less than offshore.
Gotcha. Well, I mean, I have a pretty small pool, so
Maybe a
it's not
couple of
lot.
barrels.
A couple of
Do you
barrels.
have, do you have a feel from dealing with some of your clients as to what price production will resume in the United States? You know, I've heard $35 a barrel, $45 a barrel. Some need cash flow and they'll produce at anything greater than their lifting costs. What are you hearing from some of your clients?
Well, it needs to make fiscal sense to them. You know, at $15 a barrel, it could cost more to take it out of the ground than they're selling it for. But again, it depends on the size of the company. It depends upon their risk appetite. There are a lot of factors that go into it. You know, the reason the market trades and we have a settlement price to see, you know, what the value of crude is at that day, people take that price and they make projections. You know, I heard a lot of prognosticators saying that we wouldn't see $30 again until the end of the year. And look where we are now. You know, we're at $35 or $34 in July crude right now. Before the price came off, you had people saying we'd be in a range of 50 to 60 for a long time. But I think it depends. The markets are very news driven. The markets are geopolitical. The markets are event driven, as we see with the pandemic. So I think there are a lot of factors that come into play, but it really depends upon the size of the company and you know, what can they afford? If they take it out of the ground for $15, are they willing to sell it at $16? Who knows?
So we were talking about natural gas a second ago, and here's a question. Andrew, I don't know if you're in LNG trading, but we're getting a more liquid market in LNG now.
Right.
No pun intended. With the exports out of Louisiana primarily, frankly.
Sure.
But you know, LNG prices were linked to oil in a lot
Right.
of contracts. And now that we have these export terminals, can you talk about what you're seeing in terms of trading on the LNG side and the relationship in oil? So that's opening up a whole nother topic, I suspect.
So yes and no. Yes and no. I don't profess to be an expert in natural gas. I've been in crude oil my entire career. And we do not have an LNG desk here, so I don't see the flow of orders coming into LNG. But what I do know about LNG, and maybe it's just my personal feeling, is that there is a tremendous future in LNG, and especially with the new shipping regulations that came into effect, the IMO 2020 this year. And I may be getting a little bit off topic as well, but since you asked, I'll answer. I think that, you know, LNG plays a large role in those shipping requirements. And I think that going forward, you're going to see a lot of trading and a lot of action in LNG.
Okay.
Liquefied natural gas for those that don't know.
Yeah, thank you for that clarification.
Sure.
So where maybe John or Andrew has in front of him, somebody's asking about, you know, where is natural gas trading now on
I don't have it in front of me. John, do you see it?
$1.72, 75, somewhere in that
Yeah,
range.
somewhere around there. $1.75.
I don't have it
Yeah.
pulled up on the ticker right now, but you know, natural gas prices are considerably low. We saw a brief rally whenever a lot of the oil supply cuts were announced. Then at the same time, you saw spot LNG, FOB Asia get to below, I think, $3 at MMBTU, which was bearish. So even with the oil production cuts and some of the bullish news for gas, it's still been pretty range bound between $1.65 and call it $1.90.
Yeah, the price of natural gas has been depressed for quite a while now. But as you mentioned, John, there was a slight rally, which actually took us into a bull market in natural gas. I think it was at around $1.90 or $1.92. We came right off of there. But to get back into a bull market, it's not going to take much in natural gas because the prices are so low.
And well, I might jump in from my perspective watching some of this. When we were bringing on all this oil production, particularly from the Permian, they were granting flare permits in order to continue to produce the oil. As you mentioned, I jotted down, you said we were back at 60. So you had natural gas as practically a byproduct. And so we were flooding the market and depressing the price of natural gas. Now, when we see the shut-ins, some of the oil that is being produced and has associated natural gas with it, you're going to see a drop in the natural gas price. Now, I think these are the questions that are coming in around this comparison. There's a 6-to-1 ratio if you take the BTU content of the gas price versus oil. So, if you have a $10 price on natural gas, or I mean a $10 price on oil, you're talking about, 6 of that for the natural gas. But it's not as fungible as you would think, and until it gets converted into LNG. And that's when I started to comment in the beginning. Oil is primarily a transportation fuel. 75% of petroleum goes into transportation, and because again, it's easy to transport it. So you won't see as much substitution effect, even though the BTU content is 6-to-1. I think that's answering the question there. And you're having some helpful prior students back you up on that gas price, John. So that's right.
Good.
Well, good. Well, go ahead.
Good here. I was seeing if we had any other questions coming through. I had a few on my list. I think we've covered a lot of the major topics. I guess one thing we didn't touch upon too much was Andrew, I don't know, and please just, you can scrap this question if you don't want to answer it. From a volatility perspective, where we are today versus 2 weeks ago versus kind of what you see near term.
Right.
What is the overall volatility of the oil market? I mean, are we $34 today? It looks like we're up about 40 cents at 34.66. Lots of volume and liquidity. What are your thoughts from a volatility perspective?
Well, again, you're always going to have the most volatility in the front of the board. The spot month, July, August, all the way through maybe December of this year. That's where you'll have the most volatility. And again, the market is very news driven. So what we've seen over the past few days, we've seen a rally in crude oil, but we're not seeing, although I was going to say we're not seeing the large percentage moves, although I think just 2 or 3 days ago, we did have a spike of maybe 8 or 10% in crude oil. I think as people get back out on the road and the demand is there, we would still have that volatility right now. And as any news report comes out, if cases start to go up and people stay in, or if there's a second wave come the fall, I think that's all going to play into the volatility. In a typical market, in a normal world, if there ever is such a thing, you have volatility, but you're not seeing these spikes like you see right now, if that answers your question.
It does.
Okay.
Andrew, there's some questions here around, the speculators, and I think this is a reference to the fund that was out there, USO, and their positions that were going into that expiry. Did you have some thoughts on that?
So USO is an ETF that tracks the crude oil market. A lot of people, as I mentioned, when commodity trading went electronic, the same thing happened with the stock market. So again, people can sit in their living rooms and trade. They can call up all day long and trade in that position. So a lot of people that are not familiar with the market thought that the USO ETF is just based on the price of crude oil, but there was much more that went into that ETF. It wasn't just the price of crude. So, it was very volatile. as the crude market was. But again, it just wasn't the price of crude. There were treasuries in there. There were other products in there that made that market, that made that ETF whole. Since we saw the May expiration and what happened, I believe that USO, and I'm not 100% sure of this, but I believe that USO has now gone to not having their open interest in the front contract, but they may be in the next two contracts.
That is correct.
Yeah, and I think that's the point about not being caught like that. There's a question about specifically around when the demand coming back, and you've mentioned demand increases for gasoline demand and people flying again and jet fuel demand. And I just happen to have some material here that was prepared. I'll give a reference to some J.P. Morgan work. Maybe there's some Freeman graduates working as analysts that did the backup for this, most probably. But in the second half, you see the projections are that the gasoline demand is what comes back rather quickly, and
Right.
and I think that maybe was your point earlier, Andrew, that the jet fuel takes a little longer to come back. I think that answers the question about which comes back sooner, and again referencing some work done.
And I also think that the jet fuel, I mean, it halted 100% immediately. So the airlines already had all this stored jet fuel. So they're not now, and they had, contracts that they were supposed to take delivery every other month. You have jet fuel sitting in the port of Rotterdam that's supposed to be delivered here, and Delta's supposed to take delivery of it, but they don't have a place for it because they're not using the current fuel that they have. And again, to my point earlier, people are going to be more comfortable getting on the road and driving as opposed to getting into an airplane. This is the beginning of driving season now for Memorial Day through the summer. This is the first time, I believe, in its history that AAA didn't put out a report on driving season as to what they felt was going to happen, because they just don't know. At this point, nobody really knows. But I do think that the demand for gasoline will be there over jet fuel.
Yeah, that seems to be backed up by this data here. So if the price of gasoline is about 50% driven by the price of crude oil, I guess you're saying that the futures market's indicating we're getting a slow recovery. So I should go ahead and fill up my tank before I drive to Disney this summer, right?
Absolutely. It's inevitable that as the price goes up, we see those increases at the pumps, sooner than if the price is going down. Typically, the formula is for every $1 of crude oil, we see a 2.5-cent increase or decrease in the price of the pumps.
Got it. That's a useful number. That's great.
Yep.
Well, that's great, guys. We're kind of running up on our time. I didn't know if you had any final thoughts about the expected volatility go forward. John and Andrew, do you see that the fact that we have all this knowledge about the futures market, and some have, quote, learned their lesson around open contracts into expiry, do you see decreases in volatility going forward, regardless of the shape of the curve, or increases?
I think I touched on the volatility, slightly. I think it's very news driven. I think, whatever headlines come out is going to move the market. One thing that I will throw in here, though, when this whole thing happens with the May expiration, when people are trading, they need to be backed by a clearinghouse. A lot of the clearinghouses, and I don't know anybody specifically, but I imagine that some of the clearinghouses got hurt if they were not doing correct risk management and watching the positions of their traders. So what they did was they limited trading in the spot contract. So when June became the spot contract, unless you had an exorbitant amount of money in your account to secure your account, you were not allowed to trade the June contract. So that's going to cut down on volatility right there, because they're not allowed to trade that contract as speculators.
Got it. John, last thoughts, and then we'll turn it back to Megan here.
No, just wanted to thank Andrew and the Energy Institute team. This was fantastic. I enjoyed it. Andrew, thanks for letting us put you on the spot. We appreciate
Thanks
all
very much. I enjoyed it. Thanks for having me.
Thanks, Andrew. Megan, back to you.
Hello. Pierre, Andrew, John, thank you so much for this interesting conversation today. I also want to thank the Office of Alumni Relations and everyone for participating in this webinar. If you were my students, you would all get full marks for participating. Also, there were a lot of questions that came up, and that was great, but we didn't get quite all of them. So we will be reaching out to you all with all of our contact details. So if you have questions about executive education at the Stewart Center or the topic today, you'll be able to get in touch with us. Stay tuned for details on our next exciting webinars, and thanks again for participating. Bye-bye.